You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have AutoTrader, Pets at Home, B&M, AJ Bell, M&S, and our US company of the week is Zoom. And today is the 12th of June. Sam, shall I kick us off with AutoTrader?
Yes.
So AutoTrader, the FTSE 100 listed car portal, had their full year results out recently, with full year revenue up 65% to £432.7 million and 17% ahead of pre-pandemic levels. Operating profit was up 88% to £303.6 million, with higher costs being offset by increased revenue. And it's worth pointing out that the numbers are somewhat distorted from the pandemic numbers with AutoTrader in a similar way to Rightmove, because they gave their customers fee breaks during the pandemic. If we break those results down a little further, then average revenue per retailer, ARPR, increased by £886 to £2,210 per month, giving a total increase of £247 million as a result of price increases, favourable stock movements, and customers choosing more expensive products and packages. Forecourts advertising with AutoTrader were up 5%, bringing the total to 13,964. And overall trade revenue was up 72% to £388.3 million, whilst customer services revenue was up 25% to £33.3 million. The group did note that the increased used car prices were having a positive effect for a large part of the customer base and their profits, with the supply shortage meaning that new car registrations are 22% behind 2020 levels with the semiconductor supply issues. Average monthly platform visits rose 9% to 63.8 million, and minutes spent on the platform was up 5%. Costs, including marketing outlay, were up 27%. Operating margins, meanwhile, rose from 61% to 70%, and the group generated free cash flow of £269.1 million. Net cash stood at £41.7 million, and a final dividend of 5.5 pence was announced alongside the results, taking the full year dividend to 8.2 pence. The group said, "We're anticipating another good year of ARPR growth underpinned by our product lever. We expect growth in the product lever to be greater than 2021, but less than the exceptional performance achieved in 2022. We expect the price lever to be broadly consistent with last year and the stock lever to be flat. We anticipate the average retailer forecourts to be marginally down year on year as market conditions start to toughen." In terms of valuation, AutoTrader has a market cap of £5.3 billion and trades at just over 20 times earnings, compared with around 24 since listing. It has a prospective dividend yield of about 1.7%. I thought these were very impressive numbers, although the comparators do flatter the performance, in that the company did make the choice to reduce the revenue during the pandemic and lockdowns with the ad fee breaks. However, they are 17% ahead of pre-pandemic levels 2019, which is impressive. I think it's a fantastic company and almost holds a monopoly as an online car sales platform in the UK, similarly to Rightmove when it comes to the property portal. And I think that's really reflected in those very juicy operating margins of 70%. I suppose the main risk for AutoTrader in the short term is if car demand falls with sort of stagflation in the UK and the volumes decline. I think that's probably reflected in the price, why it's just 20 times earnings and cheaper than it has been in recent years. But it's definitely one for my watch list. What are your thoughts on AutoTrader, Sam?
I like it. I think these are very good results. You would expect them to be good, given what's been happening with the car market recently. My only real complaint about it is the same one that we have every time, where I just don't think it's quite as good as Rightmove. So those are like the operating margins at 70%. That's a very impressive figure. But those are operating margins, and Rightmove has net margins over 70%. I think it's about 75%. So there is,
that's it.
and they are very similar businesses. So I don't know what the difference is, but I think they could get those a little bit higher. But in terms of the valuation, I think P of 20 is very attractive for a business of this quality.
Yeah, I would completely agree. And it hasn't been this cheap for a while. That's for sure.
No, this is the cheapest since we've covered it. It's normally about 25, isn't it?
Yeah, I'll just see what Rightmove is, because that's pulled back too. Okay, so Rightmove is 26 at the moment, 26 and a half.
Okay. What are the when's the year end for Rightmove?
So I think the full year results for Rightmove were out at the end of Feb.
Okay. So they do have a different year end then. So there's about a 4-month difference. So I don't know if it's the fairest comparison, because I imagine Rightmove's absolutely bombing away at the minute.
Yeah.
But then the interim results will be out in a couple of months, won't they? So that'd probably be the best comparison. Yeah. But I'm sure we'll cover it when they come out. So
yeah. Fine. Okay. So pets at home.
Yes. So Pets at Home have come out with their full year results, and full year revenue rose 15.8% on a like-for-like basis to 1.3 billion. That reflects market share gain across all business areas and record numbers of new customers. Underlying pre-tax profit of 144.7 million before certain accounting charges were ahead of expectations and 65% higher year on year. Industry-wide inflation is being managed proactively, and the group expects full year underlying pre-tax profit of 146 to 157 million. A final dividend of 7.5p was announced, up 36% year on year, taking the total annual to 11.8p, and that's on a share price of 321p. The group also intends to launch a 12-month share buyback program of up to £50 million, and that's on a market cap of 1.6 billion. Worth noting as well, a new CEO, Lisa McGowan, took over at the end of May. If we break the results down a bit more, in retail, revenue grew 15.8% on a like-for-like basis to 1.2 billion. Within that, both online and store revenue grew mid-double digits. Online sales represent 15.8% of total revenue, flat on the previous year. An increase in advanced nutrition take-up and growth in dog toys and training accessories helped food and accessories revenue grow 21.3% and 13.7% respectively. Despite operating costs rising 11.9%, underlying pre-tax profit rose from 67.5 million to 114.6 million. Vet Group like-for-like sales grew by 17.1%, but overall revenue declined from 123 to 108 million, given the disposal of the specialist group. Like-for-like fee income from joint venture practices rose 20.9% to 69.9 million. Underlying pre-tax profit grew from 35.5 million to 44.5 million as cost efficiencies helped margins. The number of active VIP, which is very important, pets, club members, grew 1.1 million to a record 7.3 million. 27% of VIPs shopped across more than one channel over the year. Puppy and kitten club members grew 36%, with an average of 23,000 registrations per week. The number of pet care plan subscribers was up 23% to 1.5 million, generating over 120 million in recurring revenue. Group free cash flow was up 40.9% to 95 million. Net cash, excluding lease liabilities, increased from 1.4 million to 66 million. In terms of the valuation, the PE ratio is 12.12, and that compares to an average ratio since listing of 16, and the prospective dividend yield over the next 12 months is 4.3%. These are very good results. However, I do think they've probably been an unexpected lockdown winner because they benefited from all the lockdown puppies that everyone was getting. So if we look at the results for the last 5 years, revenue has gone from 900 to 961 million to 1.05 billion to 1.142 billion, which was in the lockdown year, I think. Was it 2020 COVID started?
Yeah,
it was. Yeah. So lockdown year, it went from 1.05 to 1.14 billion. and it's now up to 1.3 billion. So it is consistently growing, actually. I'm surprised to see it doing this well. I did not realize it was this good a business. It seemed to me the sort of business that you would have expected Amazon to eat away at. And that doesn't seem to be happening. And as well, the online sales represent 15.8% of total revenue. That's still very, very low. I think they could get that a lot higher. And then as well, although I'm not sure about this point, but the revenue coming from vets is, it's like 10 to 15% of the retail revenue. That could be a lot higher too. The only thing is I don't know if it's similar to Halfords, where although it's a very big industry, it's very, very fragmented. So that's not a give. But I'm surprised how cheap it is considering how well it's performing. What are your thoughts on these results in the business, John?
Yeah, I mean, I think my fear since we'd sort of started covering pets at home was always that it was going to be eaten up by Amazon. It was just ripe for that. But it seems to be much more resistant, and actually perhaps a bit like Tesco's with the club card. You've got the VIP scheme, and if you integrate and expand the vets, and I don't own a pet myself, but I can see the appeal that you might have almost that sort of one-stop shop going in. If the vet's also like competitively priced too, why you might just sort of put everything through that on sort of like the VIP membership. And then certainly at the moment, in terms of valuation, it's certainly not expensive. I suppose if you don't think that the trends with pet ownership are sort of going to continue to grow, but I suppose nothing to say that they're not. They obviously slow from that sort of lockdown boom. And it's got a very decent dividend to go with it. So I suppose I think it's good value at the moment.
Yeah, I just think as well, with a P of 12, if they can get the online sales up, plus where it's saying they're getting, I don't know where it says pet care subscriber plans, they're getting 120 million in recurring revenue for that. I don't know what that is. I don't know if that's like the food is getting delivered monthly or if it's the worming products, but whatever it is, again, they could probably get that higher because that's 1.5 million pet care subscriber plans out of 7.3 million VIP club members. So just within the VIPs, they've got a lot. They've all presumably got pets. So there's a lot of scope to increase that as well. So this one surprised me actually.
And there are all sorts of add-ons, with your pets, insurance, and like you say, there's the veterinary side or the veterinary nursing, having the claws trimmed, all of that sort of stuff. And then there's sort of almost that recurring revenue from things like the food, or food subscription. So I think it was maybe it was judged a bit harshly when we first looked at it. But
I think if it does turn out it's Amazon proof, it looks like a very good business actually.
That's right. And I think that is the worry. Like traditionally, when we've been looking at retailers, like, are they Amazon proof? And you're always a bit nervous that Amazon comes in and then dominates, and your business is almost worthless. And it's got all of those sort of like more expensive overheads that Amazon doesn't have. But I think actually, and it's under 13 times earnings.
Yeah, and it has grown. I mean, it's not amazing growth, but it's. In fact, I'll just work it out. But in the last 5 years, revenue is up about 40%, 44%. Yeah. They did benefit from lockdown, but the revenue was still going up. It was still growing. Revenue was still going up before then. It was going 5 to 10% a year in any case.
Yeah,
it's surprising.
No, absolutely, absolutely.
No, I like it. Should we move on to another good business? Another good retailer as well, actually.
Well, so B&M, it's one we've covered before, but it's the home discount retailer. And they had their full year results out recently, with the chief executive, Simon Aurora, issuing profits warning with a reverse of the 2-year sales boom that they've had, and shoppers shifting away from spending on the big ticket general merchandise items with the high margins to more of the budget food and personal care products. And B&M are now expecting lower earnings between 550 and 600 million pounds, compared with 619 million pounds that was achieved this year. However, this is still significantly ahead of pre-pandemic numbers. And it was, just for reference, it was £324 million in earnings in 2019. And Mr. Arora has been at the business, is retiring after 17 years and handing over to Alex Russo, who's been with the company for a couple of years, but he's been in retail longer term. So in terms of the results then, the group revenues were down 2.7% year on year to £4.6 billion, but they were 22.5% ahead of pre-pandemic levels. B&M UK like-for-like sales were down 9% to £3.9 billion, but 13% ahead of pre-pandemic levels. And there were 34 new store openings in the UK with 14 closures. Heron Foods opened up 60 new stores with 11 closures. And the rebranding process of the French business has now completed, with 107 stores now all under the B&M banner. Revenue actually increased in France by 14.2% to £353 million, and EBITDA nearly tripling from 11 to £32 million. Group adjusted EBITDA was down 1.2% to £619 million, which is over 80% ahead of pre-pandemic levels. Cash generated from operations came in at £598 million, and gross margins increased from 36.7% to 37.5%. The group also highlighted that analysis from Barclaycard shows that the retention rate of new customers from 2020 being 83% and from 2021 being 73%. Predominantly low and middle income families, which represent 15% of all UK shoppers, and that they hope that this should continue with the cost of living crisis and B&M's value for money proposition. The group also shortly going to be launching an online platform, initially just with a range of seasonal products. That's something that they've been reluctant to do for the last couple of years. Net debt to adjusted EBITDA of 2022 is 1.3 times, and that's remaining comfortably within their target of 2.25 times. Final dividend of 11.5 pence was announced alongside the results, taking the full year ordinary dividends to 16.5p, in addition to the 25p special dividend that was declared in December 2021. In terms of the outlook, B&M are saying over the first 8 weeks of full year 23, B&M UK like-for-like sales performance is between minus 13.2% versus full year 2022 and minus 11.5% versus 2021. And this reflects the impact of annualizing against elevated comparatives in both years, driven by pandemic-related restrictions. They said on a 3-year basis versus pre-pandemic levels of 2019, there was a like-for-like growth of plus 7.7% in April 2022, with an improvement to 10.9% in the first 3 weeks of May 2022. And in the B&M UK business, gross margin is likely to step back in full year 23 due to a more normalized level of seasonal markdown activity and a possible adverse impact from category mix. We expect B&M UK adjusted EBITDA margin to be between 70 to 130 basis points lower than 14.4% from full year 2022, but remaining structurally higher than pre-pandemic levels. New store pipelines remain robust, with gross new openings in full year 23 expected to be approximately 40 for B&M UK stores, 15 Heron Food stores and 6 B&M France stores. Notwithstanding the many and varied uncertainties and headwinds likely to impact trading performance during full year 23, we currently expect the group adjusted EBITDA to be in the range of 550 to 600 million pounds. In terms of valuation, B&M has a market capitalisation of 3.6 billion pounds and trades at just 8.5 times earnings, and currently yields just over 3%. I mean, I think the numbers it's disappointing that, as they highlighted, it's very, very strong comparators that they're going up against. I suppose it's disappointing to see that shift in terms of the mix of what they're actually selling from those higher margin items to the lower margin items. And that analysis from Barclaycard that they quoted, I think all that they were looking at was if a customer returned once, and that was sort of a repeat customer, which I don't know. You'd like to see something maybe a little bit more inspiring than that, but that was just sort of the superficial research that they conducted. I think, given the valuation, even though things have pulled back and normalized a bit more, given that we're in getting into that stagflationary environment, I guess as people are pushed, they might shop, and perhaps volumes and sales at B&M might benefit from that, even if the product mix isn't quite as good as it has been in the last couple of years. And they have been sort of exceptional years. Probably reflected in the valuation. I suppose another concern is that they've got this new chief executive, and the previous one, there'd been a lot of continuity when he'd been there for the last 17 years. I don't think I'd be buying shares, but I think it's definitely one for the watch list. Yeah, it's not a business that I dislike, but obviously slightly disappointing numbers this time. Sam, what are your thoughts?
Similar to you, actually. Last time we talked about this, I think I said I thought they were going to hold on to the COVID gains. I just felt like the execution looked like it had been very good, and they had a history of good execution, so I didn't see why that couldn't continue. It is a good business. I think this is very much a mixed bag in terms of results. It's disappointing, but at the end of the day, I don't think there's really much management could have done. I think the valuation is very, very cheap, under 9 times earnings. I think going into a recession and an inflationary environment, I think this would be a very, very good business to hold. Just because I think a lot of people are going to be, for example, I don't think it'd be you'd get people dropping from this level to B&M, but we're covering M&S later on.
Yeah.
And they've got the opposite problem in an inflationary environment and a recession, I think. But
yeah,
B&M, I'm surprised it's valued so harshly given the climate. The only real criticism, because I don't actually think the results, it's a mixed bag, but I don't really blame them for the results. The only thing I'm not sure on is they've only got 100 stores in France.
Yeah.
And that compares with 700 in the UK. The France stores are profitable, albeit at a lower margin. I don't understand why they're not opening more France stores.
Yeah. I'm not 100% in that. I don't know what the sort of explanation behind that is, why they're not being a little bit more aggressive.
Because 6 is low, especially when they are profitable.
Yeah, absolutely. I suppose that's probably one for the new chief executive.
Yeah,
so we'll see.
Hopefully. But again, that if they could kick some growth into it, that would be quite nice.
Yeah, absolutely. And when you're valued at 8.5 times earnings.
Yeah, you're not really priced for growth. So
you're not really priced. Yeah, exactly. So. Okay, fine. Is it one that you'll add to the watch list, or?
I think it's good enough for the watch list. I do like it. I think for me, it'd always be opportunity costs. I think I'd always be able to find a better business than B&M is the thing. I know we're talking about France, but I wouldn't expect that much growth. Whereas the stocks in my portfolio do just tend to be growthier. It's like, I don't know, if I was 50 or 60 years old and I just want stability and income.
Yeah,
I think I'd be considering it quite seriously, because I think it is a good business.
Yeah, fine. What about AJ Bell then?
Right, AJ Bell. So they have come out with their half-year results. I'm going to do this in a bit of a funny order, just because the results were a bit difficult to actually flick through. So I've gone straight to the slide. Good. Yeah, not a good sign. Partly it's just the PDF downloaded in a format where it didn't let me highlight stuff. So when I'm making my notes, that's just really annoying. In case any of the listeners actually care about that. little snippet of how we do it. Whereas with the slides, I could highlight. So what it means is it's got some of the operational stuff before we actually get to the numbers. So the numbers will come about halfway through rather than at the beginning like we normally do. So they've come out with their half-year results. Yeah, firstly, they highlighted that they've launched Doddle, which is the commission-free investment app, which broadens their reach in the direct-to-consumer market. And they also talked about the market generally. So there was an interesting graph where it shows the household savings rate. And in COVID, it peaked at 23.9%. And that was in lockdown 1. And then I think probably the second lockdown, it peaked at 18.3%. And now it's back down to, it's down to 6.8% now. However, pre-COVID, it was actually just 4.5%. So it's still higher than pre-COVID levels. And then they also talked about the market itself. So the direct consumer assets under administration, so this is the market as a whole, is 320 billion. And that's up from 94 billion in 2012. So in 10 years, the market's more than tripled, which I knew it was a fast growing market, but I didn't know it was that fast. So it's the market's been growing at, so the market's been growing at 14% a year compounded, which I was just not aware it had been that good. And it's still growing as well, is the thing. They've announced, I think it's on the D2C side and the advice side, they've announced price reductions. So on the D2C, they've put that down to sharing the benefits of scale with their customers at a time when living costs are rising. I think it's suspicious. I think it's to take market share off Hargreaves. I think that's the real reason, but that's what they're selling it as. And then they've talked about in the direct consumer side of the business, the average customer is 43 years old with 77,000 of assets under administration and a 95.9% retention rate, which is higher than Hargreaves. They're at about 92%. They grew their customers by 10% in the half to 266,000 and their assets under administration to 20.4 billion. And for comparison, Hargreaves have 1.7 million customers, which dwarfs the 266,000. And they have, I think, just over 130 billion of assets, which dwarfs the 20 billion. So they are some way off Hargreaves, by quite a long way off. So now we've got the financials. So revenue was up 2% to 75.5 million. Profit before tax was down 17% to 26.1 million. And the profit before tax margin was down 8.2 percentage points to 34.6%. And they put the profit before tax decrease down to lower revenue margin coupled with planned investment spend to support long-term growth. In terms of the revenue split, because so the advice side is up 11% to 38.5 million, and the direct consumer side is down 6% to 30.8 million. And then the non-platform side is down 5% to 6.2 million. But on direct consumer, they said transactional revenue is down 20% due to moderated dealing activity by AJ Bellew Invest customers compared to 2021. And then Hargreaves was down as well, actually. So Hargreaves did a trading update about a month ago, and their revenue, and Hargreaves is much more direct consumer. That makes up the bulk of it. Hargreaves were down 15.7%. So the Hargreaves revenue's been hit more, but I think Hargreaves probably benefited more as well from the big spike that we saw in COVID.
Yeah.
But yeah, they're both down. And that's actually all the slides. So in terms of the valuation, the business trades at a market cap of 1.1 billion and at a PE of 28. If we look at the financials for the last, since they listed, so we've only got 4 years, but revenue's grown from 89 million to 145 million. But in that time, Hargreaves has grown by a similar amount. I don't think they've really taken any market share. If they have, it's very small. They've just grown in line with the market. They're more expensive than Hargreaves. Hargreaves is at a PE of about 12, I think, or something like that. And the results are pretty similar. I don't really understand. And it's got a dividend yield of 2.5%. I don't I just don't understand why you would get this instead of Hargreaves if they're not even taking market share off them and they're more expensive. I know they're smaller, but they're not. There doesn't seem to be any advantages to that. Hargreaves seems to be benefiting from the fact that it is the market leader and it's not giving up market share to AJ Bell. And I think if you're concerned about as well, like you are with, the fees being eroded and stuff, the beneficiaries of that, they're probably not going to be AJ Bell anyway. It would be like a free trade or someone. So yeah, the results were fine. I think they're about what you'd expect. I'm just not particularly impressed with it. What are your thoughts?
Yeah, I mean, I think you sort of alluded to them, and we did talked about this a little bit with Hargreaves when we did the interview recently with Luke. But I mean, I think it's that commoditization of the online broking. It's so competitive, and the margins are being. I know that they're fairly decent, but they are being driven down. It's just, I think it's an industry that I wouldn't really like to be invested in. And yeah, it's straight. Well, I don't know why people are paying up 28 times earnings. If you were looking to buy shares in this industry or in this sector, why you wouldn't go for Hargreaves, given that there's that massive difference. I mean, compared to like 12 times earnings for potentially a better business.
Yeah, I'm biased, but
yeah, no. I mean, I wouldn't buy either, but I do.
But if someone put a gun to your head, would you be buying Hargreaves?
Yeah, I would be. Yeah, absolutely. I mean, I use AJ Bell for a lifetime ISA, and the reason I chose AJ Bell was because for a lifetime ISA, there are very few providers. I think Hargreaves and AJ Bell being the biggest two of them, and it was purely on the fees basis. It was cheaper with AJ Bell by, I don't know, it wasn't a huge amount, but it was cheaper, and just buying it, sticking the stock in and leaving it, well, why not have better returns with a lower fee?
Oh, it's worth mentioning as well, you mentioned that we talked about Hargreaves in the interview we did with Luke. So we both went on Luke Hallard's or the 7 Investing podcast as guests. We recorded it yesterday, so the 11th of June, the day before we recorded this. However, I think this will go out before that interview. So I think Luke said it might be out in about a week. So if you do want to get an extra hour of us, you can just keep an eye on 7 Investing podcast, and our interview will pop up at some point. So should we move on to M&S?
Yes. So British food and clothes retailer listed on FTSE 100. They had their full year results out recently. And these numbers are compared with pre-pandemic figures. Full year underlying sales 6.9% ahead of the pre-pandemic levels at £10.9 billion, with a strong performance in the UK food and also growth in the UK clothing and home. Operating profit was up 20% to £709 million, and again that's in comparison with 2019 levels. So if you look in a little bit more detail, UK clothing and home was up 3.3% to £3.3 billion, with strong online sales and an update of the M&S app. Discounting levels have fallen from 35% to 18%, which also helped operating profit rise from £223.9 million to £330.7 million. And that's in spite of returns returning to pre-pandemic levels. In the UK food division, sales were up 10.1% to £6.6 billion, with improved performance in the core categories and more people using M&S for their everyday shop, although there's a slight decline in numbers, but that led to per person spending growing by 26%. Costs fell with increased digitization, leading operating profits to grow 17.4% to £277.8 million. Ocado Retail, which M&S has a 50% stake in, saw revenue decline by 4.4% compared with 2021, with a normalization of shopping habits and the lower profitability at a newly opened distribution centre. The group's profit from Ocado Retail fell from £78.4 million to just £13.9 million. International sales were up 1.7% to £937.2 million, ignoring the impact of exchange rates, with recovery in the clothing and home sales, particularly in the Middle East. Food sales were impacted by the EU border issues, meaning sales fell, and there was a 33.5% slide in operating profits in the division. The Bank and Services division reported a £3 million loss, which was largely down to mis-selling provisions. However, excluding these, profit was down by £3.8 million to £13 million, with a dampened demand for unsecured credit and travel money. Free cash flow was up to £699.2 million from £493.5 million. Net debt fell by £1.25 billion to £2.7 billion. In terms of valuation, M&S has a market cap of just under £2.75 billion and trades at just 7.3 times earnings, currently yields just over 5.5%. I mean, I thought overall these results were pretty good. I think it's very encouraging to see that sales in the UK clothing and home, which has been an issue for M&S for most of the last decade, that's actually increased, and that discounting levels have fallen. And then obviously the earnings have also risen, even though they've had inflationary pressures. And then the food, which has been really delivering for them again over the last decade or so, still strong. I guess something that is reflected in that valuation is that, as you alluded to earlier with B&M, that with the increased cost of living, is a more luxury retailer like M&S going to suffer? I suppose it'll be a test for the M&S brand, and the answer is I don't know. Perhaps it's a little bit overdone, and a lot of bad news is baked into that price, as it is just under 8 times earnings. Similarly to B&M, I suppose, but one might argue that B&M's got more to gain and M&S has more to lose in the current situation. It's got a very, very juicy dividend, but again, that's if numbers start falling in that sort of cost of living crisis, then that dividend can go, or certainly be cut back. So I don't know. It seems very cheap, but I guess it depends on what your macro view of things is at the moment and the way you see it going. Probably not one for me. Would add it to the watch list.
I think these results are pretty good, and I think that's the second set of good results we've seen from M&S. Like it was a turnaround, and it is actually turning around. I agree that I think they've got a lot to lose in a recession and inflation. I think that 50% share in Ocado is going to get written off at some point. I really do. I know they had that bump in profits for the pandemic year, but they've dropped like 78 to 14 million, and I don't think they're going back up. I really don't. I suppose that's not factored into the price anyway. It's got a lot of debt as well. The net debt of 2.7 billion, if you compare that to about 700 million operating profit. Yeah, 709 million. That's high. But that's I mean, it's about 4 times. And the thing is as well, like how much of that debt was used to buy Ocado.
Yeah.
Like if the Ocado was still worth what they paid for it, they should absolutely sell it to pay off some of the debt. But I think in this market, I don't think you'd be able to. But that being said, I think the debt's high, but it's manageable, especially with the performance of the business. 7.3 times earnings, I think it's pretty reasonably priced, and the dividend is very good. So I think these are a good set of results, and I think it's a much better business than when we first started the show.
Yeah, I think that is a positive. It's the healthiest it's been for a long time. So I think it's just that if the recession comes, then how badly is it going to be hit? But yeah, if it's not, you might be getting yourself a bargain. But I don't know. I probably wouldn't be brave enough.
Yeah, I don't know how much growth you're going to get from it, is the thing.
Well, yeah, I know. And then I'm sure you'll talk about the opportunity cost, which is a very legitimate point to
it depends how bullish you are on Ocado, doesn't it?
Yeah, which on this show, not very.
No.
So Yeah. Okay, that's fine. Well, onto a more definitely a growth orientated stock. The US company of the week, Zoom.
Yes, so Zoom, I'm assuming you've all heard of it. Yeah, so they have come out with their Q1 results. And it's worth mentioning these are going up against extremely tough comparatives because, I'm sure you can imagine, Zoom was definitely a lockdown beneficiary. So total revenue for the first quarter was all these figures are in dollars. Total revenue for the first quarter was 1.07 billion, up 12% year over year. GAAP income from operations for the first quarter was 187.1 million compared to 226 million last year. After adjusting for stock-based compensation, expense and related payroll taxes, litigation settlements, net and acquisition-related expenses, non-GAAP income from operations for the first year was 399 million compared to 400 million last year. For the first quarter, the GAAP operating margin. So, by the way, John, it's worth mentioning this one is profitable. The GAAP operating margin was 17.4% and non-GAAP was 37.2%. So that's pretty high for a business still in growth mode, actually. GAAP net income attributable to common stockholders was 113 million or 37 cents per share. And that compares to 227 million or 74 cents per share last year. Net cash from operating activities was 526 million for the quarter, and that compares to 533 million last year. And in terms of the customer metrics, they have approximately 198,900 enterprise customers, up 24% from the same quarter last year. Trailing 12-month dollar net expansion, a trailing 12-month net dollar expansion rate for enterprise customers of 123%. And they have 2,916 customers contributing more than $100,000 of revenue in the trailing 12 months, which is up 46% from last year. The founder and CEO, Eric Wan, said, in Q1, we launched Zoom Contact Center, Zoom Whiteboard, and Zoom IQ for Sales, demonstrating our continued focus on enhancing the customer experience and promoting hybrid work. We believe these innovative solutions will further expand our market opportunity for further growth and expansion with customers. Additionally, in Q1, we delivered revenue of over $1 billion, driven by ongoing success in enterprise, Zoom Rooms, and Zoom Phone, which reached 3 million seats during the quarter. We also maintained strong profitability and cash flow, including 17% in GAAP operating margin and 37% non-GAAP, and a 49% operating cash flow margin and over 46% adjusted free cash flow margin. That's a big margin, actually. So what do you think the price to earnings ratio is going to be on this, John?
Oh, very good question. I would say, I know tech's pulled back a bit, or in fact a lot, 35, 40.
35, 40. So you are right on the pullback. So the share price has pulled from a high in 2020 of $478. It's now $109. It's about an 80% drop.
Okay.
In terms of the P ratio, it's 26.
Wow.
I think that's pretty reasonable.
I think for a business like this, and I think it's a business that I would always like, but it's just usually, and certainly in the last couple of years, you'd have had to pay so much for it. But 26 times earnings seems actually pretty good.
Yeah, and as well, I mean, it's up against tough comps, but I think 12% revenue growth on those comps is very good. Those free cash flow margins are insane. Like 49% operating cash flow margin. That's very, very good for a business that's still growing. And I would expect the growth to accelerate. I don't think it'll stay at 12%. I think it's just what's probably happened is a lot of growth's been pulled forward. So it's now a bit lower now. I'd expect growth in future years to be higher than 12%. And based on all the new products and stuff they're launching, it seems like it might have quite a bit of optionality. I know they're not all going to work, but they don't need to.
Yeah.
I think this could churn out a lot of cash. It already is, but at a P of 26, I mean, that's...
Yeah.
I think it's probably because it is the classic lockdown stock that you think it probably is. People think of, if you think of lockdown winners, it's probably near the top of the list.
Yeah.
And that's probably why the pullback has been so horrendous.
Yeah. Yeah.
But I think this looks pretty reasonable.
Yeah, no,
Would it be one for your watch list?
Agree. Yeah, absolutely. Absolutely. It would be right up there.
That might be the first time you said that for a growth stock.
Yeah, but I mean, for the reasons that we mentioned earlier.
Yeah.
So I think legitimately so. And I suppose if you had bought it when it was much more expensive, you would have been burnt by it. But I think now it's, a much fairer valuation. Would you even describe it as cheap?
I'd say, I think 26 times earnings for a business is, I think it's still got a long way to grow. And the market cap's 32 billion.
Yeah.
And it's one where I'd look at it and say, well, I could see Zoom being $100 billion business. And it's not difficult because a year ago it was. But
yeah. No, that's right. Company of the week then.
Oh, it's actually quite tough.
I'd actually come out and I think I'd go for Zoom. I think it's probably the best company. I think it's got exciting growth prospects and it's not that expensive. I do love the software. I think it's great. And it's continuing to innovate. So yeah, I definitely go for Zoom. Close second would be AutoTrader, but
I think I'd go for AutoTrader.
Would you? Why over Zoom?
So I really like AutoTrader. I think it's a good business. I mean, when you're on the complaint about businesses, it's not as good as Rightmove. And also, it's just, I know Zoom's very, very cheap, but AutoTrader at 20 times earnings, I don't know how long it's going to stay there. But no, I like the look of Zoom. I think it's partly as well, I guess, that I know AutoTrader a bit better as a business. This is the first time I've actually looked at Zoom.
Sure.
So will you be taking a closer look at Zoom?
Probably, yeah. Seriously, I probably will be. What concerns would you have about Zoom if you were to look at it the other way?
I don't know. I mean, it's so dominant. I mean, when you think like Skype was perfectly positioned for lockdown.
Yeah.
And Zoom's just come out of nowhere, really. Like I knew what Zoom was before lockdown, but like Zoom's become like a verb, hasn't it now?
Yeah.
Like it's like for the Gen Zs, I think it is, people born after millennials, people call them Zoomers. And like it's become the verb. So that's a good sign.
Yeah.
I know I'm meant to be playing devil's advocate. I'm struggling actually, which maybe means like maybe I should have picked it, but what was it? I don't know. I guess my main concern would be the optionality. I know it looks like they're doing a lot of other stuff, but my concern would be, well, if they're just restricted to the video calling app, but I mean, to be honest, even if that was the case, they could do so well from that might not even be a problem anyway. But it's like it's very anecdotal, but we record the podcast on Zoom.
Yeah.
And a few weeks ago, they changed the rules so that previously, I think if there was 3 or more of you in a meeting, it kicked you out after 40 minutes if one of you wasn't paying. But for 2, you were all right. So for every recording we'd done, we'd been on the free one, and we log in a few weeks ago, and all of a sudden after 40 minutes, we're kicked out. And we normally have a bit of a chinwag beforehand, and it's about an hour recording. So we were kicked out twice, and it was just a nightmare. And we've managed. We don't want Zoom finding out, but we've managed to password share with someone. So we've got access without paying. But I think if we hadn't have been able to do that, I think we'd have paid for Zoom the 10 quid a month or whatever it is before going to another platform because it's so easy to use. Would you agree with that?
I would completely agree with it.
Yeah.
In fact, that's what I suggested.
Yeah. Well, yeah, but we saved the 10 quid a month, so, which you can now invest in Zoom.
Yeah.
Save it for a year and you can buy a share.
Okay.
Right. I think that's everything then.
I think that is everything. Thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.